All right. So in also talking about your RRSPs, as I said, what they are ideally for your retirement years. That is very important, right? Because as I'll chat about a little bit later, it's treated a certain way tax-wise. It is a good tool to use for the right situation. However, it can be treated a certain way. So here's what we talk about the RSP. The government gives you a deduction of your taxable income for each dollar you deposit in the RRSP. This can be a very useful tool, but as I said, like most tools, it can be used to help, and misuse can and definitely will hurt. If you withdraw from your RSP, every dollar that comes out counts like income that year. So it's like you're getting income from additional job, which requires when you're working in Canada that you pay taxes on your income. So that is how it is treated, okay? The only two times you can borrow from your RSP is for lifelong learning plan and home buyers plan, right? So what those are, just a sec here. All right, lifelong learning plan. You can withdraw or borrow up to $10,000 a year for full-time education of you or your spouse. You can do that for up to $20,000 total. You have a repayment period of 10 years. So what's expected is that you pay $110 per year. So let me kind of break that down. I'll use simple numbers. For $10,000, let's say you borrowed $10,000 for your post-secondary education, okay? You're going to school or you're done. Now you've got a loan of $10,000. Let's use $50,000 for income because that's kind of the number I've been using. Fairly simple for me to calculate. Okay, if you put any money in your RSPs for that year, so let's say you put $2,000 in your RSPs for that year, right? The government will look at it and say, okay, we've got $1,000 that needs to be paid back. That's paying back the loan. So we will give you a deduction of that other $1,000 from your $50,000 income, which means your taxable income for this year will be $49,000. You put $2,000 in RRSP. Doesn't have to be the exact same one it came out of, right? Because you can have multiple RRSPs. At the end of the year, they look at the category. How much did you put in RRSPs or withdraw? So 50,000 income, 2,000 contributions, but 1,000 went to pay back your loan. So you've got a deduction for $1,000, which at that tax rate, you're looking at about $300 refund if everything else is equal. So that's how that works. So let's say you have a year where you don't put any money in the RRSPs. Then that $1,000 becomes calculated as income for that year. So now you owe $51,000 in taxes. And if you were breaking even, otherwise, then you would owe some additional funds to the government for taxes. So that's how it works when you're supposed to pay back in years where you haven't put any money back. Okay, you can pay this off early. If you're putting, say, $10,000 in your RSP, you can just let them know, let the government know that this is to pay back all of my RSP loan. And instead of counting it against your income for deduction, they can just use it to pay back all your loan. All right. The home buyers plan is the next one, and that one has gotten better and better. They just raised it to $35,000 from $25,000. Okay, so if you qualify as a first-time home buyer, and I notice I said qualify as a first-time home buyer, it doesn't mean it's only for first-time home buyers. There's some additional people who can qualify. But if you do qualify, you can borrow up to $35,000 each. So if there's two people, from your RSP to put as a down payment. The funds must have been in the RSP for more than 90 days. So just like with the lifelong learning plan, you can't put it in today and borrow it out tomorrow. It has to be in there for at least 90 days. With this one, you have a repayment period of 15 years. So let's say you used $30,000 for your down payment, or $30,000 borrowed from your RSP for your down payment. A couple of years, so if you did it in 2021, by 2023 it's due, okay? That 115. So you would owe $2,000 per year. So similar situation. If you put $5,000 in your RRSPs that year, $2,000 would go towards your loan obligation, and you would get a credit for $3,000 against your taxes, which would make your taxable income now $47,000. right? And then that 3,000 less would trigger whatever refund there would be associated with that, right? Which would be in the neighborhood of about $1,000. Okay, so that is how the home buyers plan and the lifelong learning plan work. Similar, great tools. They're not for everyone. I've had clients use the lifelong learning plan, not many, but a couple have, and I've had quite a few clients use the home buyers plan. I've also had quite a few clients say, I don't want to touch my RSPs to do this. And you know what? That's okay. The beauty of it is it's all choices, but I let them know their options so they can make the choice that makes sense for them, right? So I kind of use that example about if you made the 50,000 a year, typically your employer would have drawn enough taxes for that. But if you put 5,000 in RSP, then you get the deduction in the amount of roughly 1,500, all things being equal. Your taxable income in this case would be 45,000 before any other deduction. So again, this is what I was talking about a little bit earlier, just giving an example using 5,000. This is without loans. This is just typical RSP deductions. But a great part of having someone like myself who has expertise in this field is learning how you can stack things. What do I mean by that? Well, if you're in the case where you would have had $50,000 of income, let's say that's your taxable income, right? And you put 5,000 in your RSP, you now have 45,000 in taxable income. Now, how does that help when I talk about stackable? You get a refund for doing that, which is fantastic, but it gives you a couple of additional things. If at the same time you're depositing $500 a year into an RSP for, say, your 2 children, then that RRSP contribution lowers your net income to below the $48,535. So each child will get an additional $50 in education savings grant to their RESP. Now, $50 each or $100 in 2 children's case may not sound like a lot, but you use the same $5,000 that you put toward your retirement to give you a refund now and get extra deposits from the government for your children's education. That's using money to help improve yourself now, improve your children's funds now, and you're also putting some money away from retirement. That is a great way to stack things in your advantage. Right now, things make more sense when you use it and you have a plan and it makes sense for your situation. So again, by putting that 5,000 in RSP, this person not only qualified for a $1,500 tax refund, but also the additional $50 for each child for their education. Okay, this is when understanding the rules in the money game and you start winning more personally, that's when things start getting nice, getting sweet, and you feel even better about your choices, right? So the tax-free savings account, I did put savings in bracket because I do not like that they call it the savings account. And the reason for that is that has had a lot of people thinking of it just in that term, only as savings. The tax-free account, as I like to call it, allows you to put money in cash, so savings. So that's straight cash, GIC, funds, or individual stocks, right? It is a wonderful tool to have. It is it's kind of like the Swiss Army knife in a way of some investments, and I'll explain to you why. Money in a tax-free savings, you don't get a deduction for depositing, but more importantly, on the other end, you don't have any taxes when you withdraw. This is going to be very important throughout the rest of your life, right? And I'll explain what I mean with that. I've got some clients who are retired now. They've got just money left in RRSPs. Unfortunately, I wasn't working with them from the beginning. I took over their situation later in life, but need some extra funds, want to take out some extra funds out of the RSP. And this is a couple of them. I'm never going to name names, but said, hey, can I get an extra 8,000? You could, but here's what happens. This is why it's very important to work with someone who knows what they're doing. If you go take that out in your situation where you qualify now for the guaranteed income supplement, then that's going to put you in a higher tax bracket next year. And that does 2 things. You're going to have taxes owing on that, about 25% minimum, right? So take 8,000, you owe $2,000 in taxes. That's enough of a painful thing. when you're in a spot where you need money, because that means things aren't going great. So now you're going to pay an extra $2,000 in taxes. Doesn't stop there. Your income is now too high to qualify for the guaranteed income supplement. So what happens now is that for 1 year, at least, you lose that supplement, which is about $6,000. So what did $8,000 out of your RSP cost you in certain situations? It costs you $8,000 in that year. That is painful. That is very painful. Now, with proper planning early, that can be minimized or avoided. So that is where a tool like the tax-free savings comes in. If this client had had the funds in the tax-free savings and went in the same situation, not only would they get their full $8,000, it doesn't count as income when it's coming out, so it wouldn't affect their guaranteed income supplement. That is huge, right? That is the advantage of working with me and someone like me who knows what they're doing, right? So let me get into the tax-free savings a little more. So since 2009, Canadians have been allowed to save funds in a tax-free savings account. So the contribution amount for 2021 was $6,000 for the year. And a Canadian who is at least 18 years old in 2009 has a cumulative contribution amount of $75,500. So it started out at 5,000, then went to 55. 1 year was up to 10,000, but then it dropped back to 55. And it's indexed. So every few years it'll raise. Now it's at 6,000 per year. So you have a total of $75,500 room if you're at least 18 and a Canadian in 2009. Okay. Now, the beauty of it, as I mentioned, is you can withdraw your funds tax-free anytime for any reason. You have to be careful not to over-contribute, as the penalty is 1% per month. You also get to reuse your withdrawal room the next year. So let me expand on that, because a lot of Canadians were in trouble. If the government had stuck to the rules the first 2 years, there would have been a whole bunch of penalties. So they forgave the penalties for the first 2 years. And then by year 3, some people weren't learning, so they just started getting penalties, because a lot of times we just have to learn the hard way. I'll say this, none of my clients who let me know what was going on had this issue, right? So let me explain what I'm talking about here, okay? Let's say you had $60,000 accumulated in your tax-free savings account in March 2020. And for whatever reason, something bad happened, good opportunity, just want to go spend some money, whatever reason, don't care, doesn't matter. They withdrew $40,000 in August. So things went well, you did what you needed to, you have the money to put back, and you decide you want to put it back in December. If you're working with me and that's going back into a tax-free account that I helped you with, I'm going to say, ooh, let's wait until January, because your total deposit limit up till December 31st, 2020 would have been $69,500. So you've already deposited 60. Let's say you deposit 60. You're going to add another 40. That would make you have a total contribution of 100,000 within the year of 2020, causing an overcontribution of 30,500. And that would trigger a penalty of 1% a month. So let's say you're not working with me, you're doing this on your own through your bank, whatever. You don't realize until April, after doing your taxes, that you have overcontributed. So you would have had a penalty of $305 a month for 4 months. You would have paid $1,220 in penalties for something that could have waited another few weeks. Knowledge and accurate knowledge is power and helps you win the game better or avoid more losses, which in itself is a win. Because waiting until 2021 to put back the 40,000, you get your room back the next year. So you get your $40,000 that you took out, you get the room back this year, which means you didn't overcontribute, and then you get the fresh $6,000 for this year as well. Very important to keep track of this. And that's part of what I do for my clients. Now, we started with the fun stuff. I'm getting to life insurance, critical illness. People are like, oh my God, I don't want to talk about this. You know what? You may not want to, but we need to. We start with the fun stuff, the RESPs, the RRSPs, and the tax-free savings. Okay, and now we're going to chat about the other side of things. Because at the end of the day, accumulating money, yeah, it's way more fun to talk about, way more desirable than talking about insurance. It's like, good God, I don't want to talk about this stuff. But here's the reality of it, guys. This is very, very necessary and important. And this is where a lot of us fall short. Yeah, this is where a lot of us fall short. And quite frankly, this is where we make the mistakes, because it's not a fun topic. Nobody wants to talk about it. Nobody wants to be, nobody wants to be spending money on insurance, or at least that's what I hear quite a bit. I even hear some things as ridiculous as, I don't believe in insurance. Guess what? I have never gone to deliver a check and had someone say, nope, don't believe in it, take the money back, right? So yes, paying for it, not so much fun, but not believing in it, come on, that gets a little ridiculous. Anyway, let's chat some more. So where does insurance come in? Well, at the end of the day, it's like building your house without a foundation. Now, it can look good from outside, right? Because we tend to go after things that people see, not the substance things that are behind it, right? They see the nice house, they see the nice car. Nobody knows what your finances are really, but if you don't have your foundation there, when the storms come, you get some strong breeze and heavy rain, you're going to be in big trouble. And the same people you're worried about impressing will see what is behind the curtain. So having life insurance is like spraying silicone in your bucket before you fill it. It plugs the holes before you start losing your water, right? We all know that analogy of when you're trying to fill up a bucket and a bucket has holes and you keep pouring water in, you might get water in faster than the holes leak out, which means it might still fill up to a certain point. But what happens when you stop pouring that water in? It's just going to keep leaking out, right? So let's use that life insurance to plug the holes. All right. So let's say we have a family, right? Couple of adults, 2 children, and they're investing $500 a month for 4 years. They're just putting it away, right? You have some growth and your funds are now worth $30,000. So they would have put away $24,000. They had some great years in the market. They're up to $30,000. But one of them passes away. Where does that leave the family? All right, well, since we're doing this with the Jamaican Canadian Association, we're going to assume that a lot of us are immigrants. Here's a question. Do you want to be buried or cremated? Most Caribbean people prefer burial, which just happens to cost a lot more than cremation. Now, a lot of people want to be buried back home, wherever back home is, Caribbean, Latin America, Europe, Asia, Africa, wherever that may be. So let me ask you a question. If you want to be buried back home, what does that cost? 15, 20, 30 grand, depending on where you're going. Your body gets shipped back. Which funeral home is going to receive it on the other end? What are the costs there? Who is going to pay for your celebration of life? Will it be the family back home? Will it be you not having to just pay for, or your immediate family not having to just pay for it, but are the customs where there could be dozens of people traveling from far where you have to provide food? That all requires funds. Your $30,000 is going to go quickly. Because let me ask you something. If your body's being shipped back home, does your spouse and the 2 kids, are they staying where they are? Or is it likely they will be going back home with you? Now, it may not be, well, right now traveling is very difficult, but let's say we get back to some sense of normalcy. What if it's not low season where tickets are cheaper? You're still gonna go. Who's gonna pay for funeral celebrations, as I said? Will 30,000 cover it? It may not. But here's another question. While you've passed away, does NMAX, Direct Energy, mortgage company or landlord, depending on your situation, do they say, you know what? We know you've had a death in the family. We'll give you a 6-month break on your utilities and rents, mortgages. No, not typically. Those bills are due, but now we're down one income and we spent all our savings. So let's say the 30,000 manages to cover everything. What happens when you come back? Well, that person's income is gone forever. I'm gonna say that again, gone forever. Now, one adult's down out of the household, and sometimes, unfortunately, it's the only adult. But let's work that we're talking about too. For the survivor, do your bills get cut in half? Does the internet go to 50% of what it was? Does your natural gas go to 50% of what it was? What about your electricity and car insurance? No, they don't. There are transmission charges, especially in utilities case, administration charges that are fairly flat. Your usage is sometimes a smaller portion of the actual bill, but you don't get a cut in your basic needs. You don't get to chop your mortgage or rent in half because one adult's no longer around. What does the survivor do? If it took both incomes to get to this point, what does the survivor do? Well, unfortunately, a lot of people are going to GoFundMe. And sometimes it works out well because really it's a popularity contest, but sometimes not so much. So some of the questions I started asking: will the survivor's income cover all the expenses and maintain the family's lifestyle? Will children be able to maintain activities? Let's say they're in soccer, hockey, basketball, whatever the case may be. Are they going to be able to continue doing those? Because stability is a huge thing when you lose a loved one or someone so important to you. Will the family be able to go back home as they used to, whether that's once a year, twice a year, 3 times a year? Will they be able to go visit the parents, the grandparents, whatever the case may be? For some people, that's a no-go. For some, it's a very important part. But if we don't have the means to do it because we're down one income, maybe the income or maybe the major income, then things become more difficult. Will the house be affordable or will they have to move? I never mentioned that. Whether it's rent or mortgage, right? If you still got that and now you're down to one income, or depending if it's only that person working, no income, how do you maintain your home? If you have to move, will the kids need new schools because you've moved? These are the unintended consequences of not having proper planning, right? Kids lose their parent. Kids may lose their home, which means the friends within that area, or at least the frequency of seeing them. Kids may lose their school because they moved to another area, they have to go to another school. So the friends and stability they're used to there is also now interrupted. Will the survivor have to change jobs to accommodate the family needs? I know a lot of families where one works day, one works night, or their hours overlap somewhat. What if now, if you have young children, especially that are in daycare, if you got to make sure that you're gone after daycare starts and you're home before daycare is finished, you may have job changes. That may not be a positive thing because the job you may not have to take may pay less. Will you have the funds to take them and keep them in these activities? Swimming, dancing, hockey, soccer, whatever the case may be. And no, also another thing, you are saving that $500 a month. Will the savings have to stop? Do you now not have the funds that you used to have, now needing more to run the household because there is less than there was before, and then you're gonna have to stop your savings? So these are just some of the unintended consequences of not having proper insurance in place. And they add up fast. And let me tell you, if you even got a GoFundMe to help out, when that money runs out, you could try to start another one, but typically that's not going to work out as well, right? So it really comes back to you to make sure you have the proper protections in place and protect your family. Okay. Critical illness insurance. So this one, I call it the selfish insurance. And the reason for that really is because it is. And let me explain to you what I mean by that. With life insurance, when there's a claim, you generally have passed away. Well, you have passed away. With critical illness insurance, when there's a claim, you're generally still alive, right? So you being still alive means that unlike with life insurance, where with life insurance, when you pass, financially, and this might sound a little strange, but financially it's better because there's a certain amount of there's a certain amount of funds that are needed. It's very specific how long you might have to pay those funds for, right? You have funeral expenses, whether that includes travel or not, then it's done. Critical illness is not quite the same. I'm going to tell you guys this from experience with family members and clients. There are people who've had stuff like life-threatening cancer. There's 25 illnesses that are covered, and you see cancer, life-threatening right there. And they could be in the hospital for a year. I had one client who lasted 4 years with her cancer. Now, luckily, they were in a great position financially, and I'd help her husband set up some other things that could help use this corporation to minimize the taxation that he had. By anyway, we won't get into that. But there's products where you can, you're going to pay for some health-related expenses where your corporation can help minimize that. But anyway, let's get back to this. So same family or same two families, because we're going to say it's two. They live side by side. They have similar income. They work at the same place, couple of kids. And that one was doing $500 a month. And then another one is doing a little bit differently, but we'll get into the details shortly. So it covers all these illnesses, but life-threatening cancer is up there, okay? So, as I said, can be one of the most selfish insurance coverages because you're going to be around to collect these funds, right? You will be collecting these funds. So, this one pays out while you're alive. It helps offset the costs of being sick. You can worry about your health instead of your bills and your health. Huge difference. Question for you guys. Regardless of what illness it is, especially if it's fairly severe, does having less stress help you heal quicker? The answer is yes, just in case you're wondering. Okay, so more stress makes everything worse. So taking away or reducing the financial stress is a huge help. You get paid a lump sum if you qualify and you spend it how you want. Who may need to take time off work to help the sick person, right? Because let's say nobody died, but one person was critically ill. Does the other partner have to take time off work? Let's say they even both have benefits at work. So the sick one gets a reduced amount of income, right, while they're off. But the one who's not sick, who's taking time off, you're not the sick one. So you're not going to get paid for your time off. You could probably use up your holidays and your sick leave. But once that's done, if you're in that position, then you're not getting paid. So your family's got reduced income from the sick person, and for a while, no income from you. What if that sick person is typically, we'll say mom, right? Not always, but let's say that's the case, and that just happens to be the person who takes care of most of the stuff for the kids. Now you got to take care of that person and the things for the kids. And let me tell you, that in itself gets frazzling if you're not typically that person. And I'll speak for myself. My wife was down, I don't know what I would do as far as me trying to run my kids to everything. Now we're in a situation where we have coverage to help provide funds to figure that out, but the physical part of having to do that and the preparation and the stress and changing my work hours and habits is huge adjustments, right? So a case like that, these are again unintended consequences of not being prepared. Because the person who's taking time off to help, their benefits don't generally pay them for the time off. That's not how it works, right? So I'll use an example. Use an example of Tyler and Lucy, and they have 7-year-old twins, Sarah and Julia. Both parents work full-time. So critical illness happens, right? The financial impact for Tyler and Lucy. Let's say Lucy was diagnosed with cancer. A critical illness like this would put a lot of financial strain on the family. It will be difficult to take care of the current financial obligations and additional expenses associated with the illness, added with a loss of income while taking time off to care for Julia and Sarah, right? So I generally get the question, what do you mean additional expenses? This is not the States, we're in Canada. The healthcare system takes care of you. It does, but you're gonna spend some extra funds. So let's say you got a mortgage loan or a car loan and there's a critical illness. One person's income is down and the other one is either gonna stop or be down when their sick leave runs out, because cancer can go on for a long time, right? 9 months is not unusual to a few years. What would happen if Lucy was diagnosed with this? How would Tyler care for her and the girls? Could Tyler take unpaid leave? Again, depends on your job. Sometimes you can, sometimes you can't. How would they take care of their monthly financial obligations? That's the big question. So I'll give you an example. Let's say Tyler had to take some time off. Loss of net income, let's say on a 7-month leave is about 20 grand. Now in this case, luckily or not, depending on how you look at it, Tyler doesn't make that much money. That's about 3 grand a month. Imagine if Tyler's making over $100,000 net to take 7 months off. That is massive. Well, let's go with Tyler being a little bit of a lower income and doing that. Treatment's not covered by benefits. Now, here's the big thing. Whether this is sometimes massage and you run out of your limit, whatever the case may be, acupuncture, a new experimental drug that's not covered, that a lot of times when you're trying to save your life, people will take. 10,000 is not an unusual number. I'm using conservative numbers for things like this. We use that. Hospital parking for 7 months. Guys, this is the one that shocks most people, and it did with myself. I visited a family member 3 days in a row in the hospital, didn't do a monthly or weekly, and it was about $75 for the 3 days of visits for parking. Okay, I checked this for the Tom Baker Center. There's actually where you can, if you get the right letter from your social worker, you can get a monthly parking for about $70, right? Typically, that's 3 days of parking daily, right? But again, you can get that a little bit cheaper, right? Because otherwise it's a couple $100 a month, but you can get that a little bit cheaper. Childcare expenses for Sarah and Julia. If you're always, if you got time off and you're always at the hospital, do you want the kids there every day? Not necessarily. So you might have to find childcare for that, right? And that may be outside of regular hours as well. Again, for 7 months, that's not a lot. Anyone with young children knows that that is very, very, very conservative, right? If you had to pay for childcare for two kids for 7 months, that is a low, low number. How about household expenses and meal prep? Okay, you're not gonna have as much time. If your wife was the one who took care of most of that, you're gonna either learn some new skills, maybe not do so well with the skills you have, or maybe you're a good cook, but it takes time to do all of this. And you've got to sometimes go and buy cleaner foods when someone's going through a health scare, right? Which generally costs more money. Better quality foods will cost more money. And sometimes this is just ordering food in from different places, not necessarily fast food, but ordering food in. So meal prep, 7 months, again, fairly conservative. We talked about private tutoring services of $3,500. You can take that or not. You can add that into the childcare expenses, whatever. We know the childcare expenses was low. But in this case, you're looking at a $40,000 cost over 7 months, which let me tell you guys is fairly conservative, right? Now that's over and above what they had for regular bills. Less income from her part, some income because she's got benefits, less income from his part, none after his vacation time runs out. $40,000. How much did they save? Okay, let me go into this a little more now. So I talk about the foundation pieces, the life and critical illness insurance. Remember, the first family invested the $500 a month. They thought that was a great thing, and it is. Okay, I'm not going to knock people for putting money away for the future. That is a great thing. What if they had sat down with someone like me who said, you know what, guys, that's great that you've got a $500 a month budget. How about we put $200 towards life insurance and critical illness for the whole family? So that's parents and kids. And then we invest $300 a month. Now, I say this, and a lot of times people are like, no, I don't want to waste the money on insurance. I need to save up some money because you never know. I've been doing what I'm doing for 20 years. This is exactly why I would make such a proposal. This is exactly why. So that second family listens to me. The first one says, not going to worry about it. This guy, no, this guy's not for us. We're just going to invest our money. We set up a self-directed account. We put our $500 away, and the 24,000 grew to 30, and they did well. This family works with me and they listen to me. And we set up a plan where we invest $300 a month and we put $200 towards their coverages. So that $200 buys $500,000 of life insurance for both parents and $10,000 each for the children. It also buys $50,000 of critical illness for both parents and $10,000 each for the children. Okay, now I get a lot of questions on why would you cover kids? They don't make an income, so that's kind of a waste of money. Well, let me ask you a question. If one of your kids is sick, who takes care of them? An adult or both adults. Especially if you've got more than one child. Now, you still got to, again, depending on what it is, you may keep both children home, but sometimes you're just going to want that other child to continue with daycare, regardless, or if they're in school, whatever the case may be, if they're a little bit older. But regardless, who might have to take time off or quit a job to take care of the kids? If you've got to take time off and you're not sick, you're typically not going to get paid for that. Yeah, vacation, great, but once that runs out, that's that. Both of you may need to take some time off because that one person may be too stressed to handle it all, right? So this is why you insure children. 10,000 is not a lot, but that 10,000, if your child was critically ill, 10,000 tax-free walking in the door is a huge help. And if these people are making, around the $50,000 or less a year, understand that for one of them, that's like 3 months take home. Huge, huge difference. Okay, huge difference. And then on the other side for the life insurance, and I've had this sometimes with close friends arguing, no, you shouldn't benefit off your kids dying. Let me tell you something. Nobody wants to collect that money. Nobody that I know anyway. But if God forbid that were to happen, this $10,000 walks in the door to at least cover the final expenses. You're not going to get rich off it, and nobody wants that. But it will help you cover your final expenses, and it might give you an extra couple of weeks, depending on your funeral customs, couple of weeks or maybe a couple of months where you don't have to go back to work. That is the value of that. The bigger value for both is that if these children have this coverage and before they're adults, they develop any health issues, they are guaranteed to have the option to continue with coverage as adults for a regular rate where their health wouldn't be considered. That's the bigger part of having these coverages. You're setting them up for their futures by giving them coverage now that they may or may not qualify for later. But at least if they want it later, they don't have to qualify medically just in case health changes. So huge importance. And that's why I always talk to parents about covering kids. All right, so let's continue. These guys talk to their friends at work or the neighbors who we spoke about, who make the same money, who would probably say they're being foolish and wasting their money. They're just paying this guy. He's just making money off you, and you should be putting money away for your future. This happens. This happens with siblings. It happens with friends, co-workers. This happens. But proper planning is proper planning. You have laid a stronger foundation. Yeah, nobody sees it. And if you guys do talk about money and they're comparing later, they're saying, hey, you know what? 5 years, you got 30,000. Well, in this case of the 300 a month, similar investments, they had 18. These guys are like, you wasted 12 grand dealing with that guy, right? You let him take 12 grand out of your pocket. Let's continue. What if the same thing happened? Okay, what if one of them died? Or what if mom had a critical illness? Which family would be in a better position to continue? Again, tools of the financial game and how you can take care of your families, truly take care of them long term. So Lucy would have been paid out the 50,000 from her critical illness claim because Lucy worked with me and we got that set up. Their 40,000 expense would have been paid and the family would have an additional $10,000 to add to their funds of 18,000, which they didn't need to touch. And that 18,000 was the 300 a month growing for 4 years plus some growth, right? They would now have 28,000. Now the family who told them that they were being foolish and wasting money, who just invested the straight $500 because wasting money on insurance is just pointless, they have their $30,000, which is great. They did have some funds that is fantastic that will help them out, but they needed 40,000 to cover expenses. So once that 30 ran out, they did a GoFundMe campaign. They were hoping for 10,000. They ended up getting 5. Now, some people might get 20, but it's a gamble. So in this case, they got 5. They would get another 5 by using their credit cards to fill the gap. And we won't talk about the interest rates on that in this situation, how hard that would be to even pay the minimum while there's only one income or maybe half an income. So after the illness, we're going to say this person survives, they would have no money and have to start from scratch again. So the family worked with me, got things paid out, $28,000 to the plus, a little bit less stress because they didn't have to worry as much about the money. And they're going, these guys got to start from scratch. How long would it take to catch up to this family? Because they've got 28,000 plus adding their 3, and now they're going to start from scratch again, right? They still got that credit card receipt, credit card bill to pay. All of this adds up. So it's not just how it looks, guys, as I said, right? It's that solid foundation, the foundation in the house that's below the ground that nobody sees, but having a rock solid foundation keeps your structure when the storms come, right? Both went through a very traumatic event, both spent some money out of pocket, but one was insured that they not only got their bills covered, they came out 10,000 to the plus to help with their family. The other guys, more stress, watching the GoFundMe, raising the money from that, adding the credit card debt, and getting started again. Do they get started right away, or do they add money for the credit card? Because now there's interest on there, but we won't even get into that part. I think you guys see where I'm going with this and why this is an important thing to have. Okay, so next. What if Lucy didn't survive? What if Lucy did die? Okay, the first family went through what happens. But let's say the $500 a month family would have spent $15,000 on a funeral, live off the next 15 to make up for Lucy's loss of income for the next year. Then what? They move to a smaller house because they can't afford it. The $300 a month family would have received $500,000 coming in. They spend the $15,000 on Lucy's funeral, and Tyler would choose to stay home with the girls for about a year, as well as allow Lucy's mom to take a year off work to come help. Different story. Think of the impact on the family. The guys without the life insurance, Tyler might have to quit that job and do a different job, right? Or ask Lucy's mom or his mom to come help out. How much more stressful is that when they don't have funds to help alleviate things? In this case, he asked Lucy's mom to come help. Great for the girls, great for Lucy's mom, and definitely a big help to him, especially if it's the type of job that he loves and that he can continue to do, and knowing that they're being taken care of by family and people who love them, and not stressing Lucy's mom either, because if she had to take time off work, she's got her own bills to pay. If he could provide funds to help with that, that helps everyone. So we're going to go a step further. Tyler decides to fund the girls' education as Lucy would have wanted. Now he has the funds to go and fully fund, or at least better fund their education, because none of this money they were doing before was going into the education at $500 a month that they'd had with the other family, right? And even if it was and they were short funds, guess what would have likely happened? They probably would have cashed that out, right? So in either case, they would have lost Lucy, but in this case, Tyler was able to spend more time with the girls while they're in a vulnerable period, and so was he. Have Lucy's mom come, right? And it doesn't have to be the same year. It could have been the year after he goes back to work, right? It doesn't matter, because it's the flexibility that the funds give you to take care of your family, right? But he gets to fund the girls' education, which they didn't have, or if they did, they would have used, because that $30,000, regardless of where you put it, would have been needed. He now puts a down payment on a house if he was renting, or if he has a mortgage, he can either pay it off or knock down a substantial chunk. Maybe he decides, you know what? While the girls are young, I'm not even going to bother. I'm still working. I'll just deposit my money somewhere and I'll keep paying the mortgage. Because I tell you what, when you've got the means to pay off a mortgage, you don't stress about it. If you can put your money to work doing something for you and continue the mortgage, you got way less stress. So in either case, they're in a way better position. And the question asks, which family is better off in either circumstance, the critical illness or the loss of life? It's going to be the ones who worked with me, who listened to me, and covered their bases by getting the foundation protecting products of life insurance and critical illness. This is how important these things are. And this is where, unfortunately, a lot of our community falls short. It's not the stuff people see. It's not the fun stuff. It's not the flashy stuff. It's the stuff of substance that really, truly takes care of your families. Nobody I know moved their families from wherever they were to come here to put them in a worse position. Nobody I know, right? We want to do better, but sometimes we don't realize the tools or the importance of the tools. And that is where working with me, you will get this education on putting the right tools in place to help your situation and to help your family. So you use the right financial tools for your situation, and it helps you build a solid foundation that can withstand the storms of life. Learning what's available and how they can work for you is invaluable. And again, talking about the RSPs and TFSAs, learning how they can work for you. So you can, when people are saying, oh, it's a ripoff, no, you just didn't use that tool to the best of your advantage. Come speak with this guy because he can help you with that. And with the right information and making the right choices, you build a solid financial future and you can win the game or definitely finish ahead of where you would have normally. Guys, that is it for my portion. Thank you. Opening it up to questions. Let me stop the sharing.